over the last few quarters, we may not have met the street expectation, but we are growing faster than everybody else. Our calendar year 11 is 26% year-on-year growth. Our calendar year 11 is 33% EBIT growth year-on-year. Our OND is 18% year-on-year growth, and EBIT growth is 26% year-on-year. So any day I will take these numbers over any other numbers which have been panned out there. I think this quarter has been fantastic, and I would say all is well now. Exactly in OND 08 when we talked about this, I had said that there are opportunities in the market when lots of deals come on the table. And at that particular time, the company has to be focused on winning those deals and make forward investments in making that happen so that you can tide over whatever uncertainties that may come in the environment in the future. So OND was a big quarter, and I had anticipated. Lots of decisions got made, and we won in excess of $1 billion in October, November, December, which will hold us in good stead going forward. And that's the reason I said all is well.
Sure. And, we'll come to this quarter performance as well. But since we're on the topic, Vineet, as you said, you had mentioned that in 2008, what you do would hold you in good stead in the next 2 years. Give us some color of these new deals that you signed. One about the verticals that you would have won them into. I see healthcare has done splendidly. Europe as a continent or as a region has done exceptionally well for you. But the pricing on these deals, etc., and stuff like that, in order to bag these, did you have to take a bit of a hit anywhere, or are these pretty much in line with what you've done in the last 3 or 4 quarters?
I think let's step back and talk about 3 mega trends, right, which I indicated at the beginning of the quarter and which were true. Number one, people are extremely frustrated with especially the global major IT companies because of the fact they showed very little flexibility in contracting during recession. That is resulting into a 30% churn when the contracts come for renewal. 30% of them are arriving in the market and going to some other vendor. That is driving a churn. Third, there is a significant vendor consolidation which is happening away from smaller vendors and some of the IOPs also who are not demonstrating the flexibility which is required into new vendors. So that is creating what I call the market churn. From our deal point of view, 81% of the deals which we won were in financial services out of vendor consolidation, healthcare out of moving out from global majors into somebody else, and manufacturing. 57% of these deals were in US and 42% in Europe. So therefore, the moment the market moves away from what we call net new purchase for growth in IT, which Asia is dominating, into churn business, suddenly US and Europe join the party. So these 3 verticals and the geographies of US and Europe are back in the market because of those 3 mega trends which I talked about.
But which again brings me to my question that if at all you had to take any kind of hits on the pricing or margins or otherwise in order to bag these, or this pretty much been in line with how you managed to bag deals in the last 2 quarters?
I think the kind of deals we are winning, and this has been proven through multiple research, price is an important criteria, but not the most important criteria. People want value, and they want tool, processes, technology to be able to reduce their overall cost of running a business. If we see a lot of IOPs are not even able to make the final 5 shortlist or a final 3 shortlist because of the incapability of being able to give the end-to-end total IT outsourcing proposition, which will ensure business continuity for the customer. Once you get to the final 3, then price plays a role. The price environment has not changed from 2008. It was competitive post-recession. It continues to be competitive. So the pricing, environment remains the same. So all the deals we have won are not A, because of price, B, it's the same price as it has been for the last 2-3 years.
Okay, we'll talk more about that, Vineet, as well. But the other highlight for the quarter, Anil, I would have to say is how the EBIT performance has been. The EBIT margins have been splendid, much better than what the street estimated. Now, what I want to really know from you is that the expectation was that because of the milestone payments that you made and some other pressures, while the currency would shore up the margins, they wouldn't be as good. They are much better than estimated. Is it purely because of what currency has done this quarter, and therefore can you extrapolate it into Jan, Feb, March, or that would be reading too much?
So, currency has certainly helped. On top of it, the efficiencies have helped. So the currency has helped to the extent of about 260 basis points. And after that, we absorbed 110 basis points in terms of the milestone bonus, in terms of the increments. And the SG&A spend, which has been stepped up in this quarter, if you look at on a constant currency basis, our SG&A spend this quarter has touching close to 15%, is 14.9%. So in spite of those investments and doing the efficiency in the business, we have been able to enhance our margins. And other thing I want to highlight is that it is not only at the EBIT level, it starts from the gross margin level. Gross margin, EBITDA, EBIT, all three levels, 150 basis points net addition in margin quarter on quarter. And it becomes more interesting when you look at the earnings per share. If you look at my earnings per share has gone to 32 rupees, which is something like 45% increase year on year.
Well, and before I come to Steve, Vinit, just come to you for talking about, one geography which we've spoken about for the last 3 quarters, and you've perennially been bullish on how Europe would shape up for you. Because you always said that where there is problems in Europe is where there lies opportunity for HCL. This quarter has been very good for you in terms of how Europe has shaped up. Is this the start of something that would continue for the next 2 or 3 quarters, or difficult to say right now?
No. It's not difficult to say. It's very easy to predict. If you look at, there is $48 billion worth of deal renewals which are coming up in calendar year 12 out of 249 deals. If we assume that 30% of them will land up in the churn, $15 billion worth of deals will move hand from one vendor to another. 50% of them are from Europe. So Europe is the biggest battleground which you will see. You have seen in the last 2 quarters, and you will see in the next calendar quarter. And if you remember, we had started huge investment in Europe 3 years ago at the cost of our margins, because we did anticipate that the first recession didn't wake up Europe, but the second recession will wake up Europe, and therefore companies will suddenly wake up and say we need to do something differently, which is exactly what's happening. So with our messaging within Europe, which is socially responsible company, which will create jobs, and the employee first culture, which we are very people sensitive, is resonating extremely well with especially the continental Europe companies, which are very different in behavior compared to a UK company or to a US company. And therefore our market share in continental Europe is extremely high, and I'm very bullish about it. That is the biggest growth area for HCL in the coming 2-3 years for us.
Steve, let me map it down to how Axon is doing. And we've always spoken about how cross-selling would help HCL Tech as a consolidated entity.
Yeah.
How has that shaped up this quarter? I see you've signed, not necessarily in Europe, but you signed one large deal as well by Axon, amongst many others. How has this quarter been for you?
Yes, so I think it's been a strong quarter for us. EAS did 6.5% constant currency growth, which we were very pleased with. And I think there's a couple of points that come into that. One which you just highlighted, which is we see increasing cross-sell in the accounts. If you look at the number of top accounts that we have 3 or 4 service lines being sold into that grew this quarter, and obviously Axon was part of that story. The other thing we saw was a number of deals in the market. I remember when we used to talk about annual IT budgets, we now see quarter by quarter IT budgets. There were some deals in the market this quarter, we grew our market share this quarter, and now we see if there's deals in the market next quarter.
Okay, Vinit, highlighting a couple of things. I was just looking at the profile of the wins that you've had as well, and looking at on a YOY basis, there are, in this quarter, I believe, you've added 2 clients which are northwards of $100 million plus. And I was just looking at the profile of customers. You've added a lot of large clients, which I'm assuming would be multi-year deals, which maybe not now, but 2 years, 2.5 years down the line, would be much more margin accretive. So now, is that the scheme of things? Because you're adding a lot of large clients. You've added a lot of large clients in the last 3 years as well. So those benefits will come in right now, and the deals that you're signing right now will probably hold you in good stead. Is that the model that you're trying to follow now? A lot of large clients as opposed to smaller fragments?
I think it's a great point, right? And that is what is going unnoticed. There are 2 things which you've rightly noticed. Number one is that the $100 million clients have gone up, have tripled over the last 2 years by adding 2 in this quarter. The $50 million squad have doubled, and $20 million have also doubled. The second aspect is, as you're rightly saying, all of our top 10 clients today are G500 or Fortune 500. 5 out of them are G200. So we took a conscious decision when recession came in 2008 that there is a significant opportunity in the G200 category, which are frustrated with their existing vendors. And therefore, there would be an opportunity for HCL, which was outside the door, to go inside the door. So what you're seeing over the 3 years and this quarter is, number one, we have improved the profile of our customers dramatically, with 5 out of 10 in G200 and all 100 in G500 or Fortune 500. Number two, because of that, the size of each, size of our customers is increasing because the quality of those customers are higher.
Anand, probably not as stellar a quarter for you, but I don't think you'll be worried too much because it's probably an aberration, and maybe the next couple of quarters you will bounce back in style.
I think, I think a couple of points. So if you look at the infrastructure services, it's still grown by about 21% Y-on-Y basis. And if you look at EBIT, it's grown by 33%. Having said that, I think what we factored in this quarter's performance is really INR depreciation and a softening of the India system integration business. So besides the infra business and public services, I wouldn't say there's anything really to worry about. Our deal pipelines, deal closures continue to be very strong, and we continue to be very bullish. Given that the second generation outsourcing is driven by churn, we are seeing an increased share of wins in there, and therefore, really I'm not too worried about that.